I think we should kickstart. A very good morning and warm welcome to all of you. So uh, this is a great opportunity we have been doing at MI Capital MICS. We have been doing a lot of webinars across different industries, and this particular webinar that we are doing for gold and diamond industry and jewelry industry is a very important one personally for me. I started my career with this industry and worked for 4 years of my initial career with this industry. And then I moved to Dubai, which is also a hub for gold and diamond industry. This particular, and I lived also very close to Gold Souk and Dera. So that has, that has a long lasting impact as far as I am concerned. So I consider this as a very special webinar for us. Although I am a finance professional, but this industry has been quite close to my heart. Now, before we get into the details of it, I would like to highlight what we have been doing on the taxation perspective, how the taxation has been evolving in UAE. And so this is our corporate and international taxation team. I would say quite a strong team that we have been able to build during last 3 years since the corporate tax law was kind of announced, and even prior to that, that it is coming. We have been cautiously working on this in order to create a very strong team. And on top of it, if you go to this, we try to relate corporate tax with international tax as well, because whosoever comes to Dubai, and this webinar is about setting up new businesses in Dubai, they always evaluate the options between different jurisdictions, including, say, for example, Hong Kong, Singapore, or a competing jurisdictions. And Dubai has been, I would say, a leading jurisdictions when it comes to setting up new businesses, even for this particular industry. We have been doing webinars as far as this particular topic is concerned. Taxation in general is concerned across different subjects, and this is all of these webinars that you can see, including the next page that you have is available on our YouTube channel as well. So whenever you feel there is a confusion in your mind, you can easily go to our YouTube channel and find out, maybe you will be able to find the relevant webinar and the topic, which is quite informative as well. On top of it, we have been invited by a number of banks, free zone authorities, other institutions, including FM channels, to speak and be the agent of change that this region is seeing when it comes to awareness of the taxation is concerned. On top of it, certain staff trainings that we have been doing across different industries, including shipping and other industries. So that's what, the journey continues. On top of it, there's been a number of events that we have been speaking on in terms of on taxation, be it events organized by Khaleej Times, CA chapters, taxation societies, Gulf News, and all. And you will see a lot of these in our corporate presentations on our website as well. These are some of our media recognitions and presence that we have, on during the course of the journey that we have had. On top of it, almost every week we are writing newspaper articles, which is being picked up by leading newspapers on various different topics related to taxation in general. So you can also access this online, and this is being published across various newspapers as well. So before I leave it to my colleagues, Karishma and Kinjal, who will walk through the details of impact of taxation on gold and diamond industry, let me take you to the journey of taxation in UAE. So this particular slide says that the tax laws was published on 9th of December 2022. However, we have been following this particular topic even before 9th of December 2022, because in 2021, a public consultation document was issued by FTA, inviting views from industries as well as advisory members of the community on the corporate taxation. We have been participating and we have been keeping ourselves appraised as well as keeping our audiences appraised on the evolution of this particular topic. However, when the law was published, it was very small law. It was just a 60-page document. Around 200 instances in that document, it was mentioned that we will clarify things later. So the law did came on 9th of December 2022, but a lot of clarities related to various other industries were not there. I'm sure a lot of you who are following this particular bit would know about this. One of the important thing, particularly when it comes to gold and diamond industry is concerned, is the trading community who is who are there, but in gold souks, who are there in free zones like DMCC industries, particularly the gold traders, the bullion traders, the the diamond traders, the jewelry manufacturers. So the clarity related to how the free zones will be treated were not there when the law was published. Some bit of a clarity came when when a cabinet decision was issued on the first day when the law was getting applicable, which is 1st of June 2023, and it was cabinet decision 55 and ministerial decision 139. That brought a lot of clarity when it come to taxability of free zones, be it manufacturing industry, be it commodity traders came in. And that was kind of a mixed news also for diamond and jewelry business community, because it had the ministerial decision did not have certain things which we wished for, the industry wished for. Like, say for example, if you are in DMCC entity and if you are a bullion trader, you would be subject to tax according to that ministerial decision that was published on 1st June 2023. However, there has been number of other clarifications, and I'm sure there has been a lot of lobbying also that happened in that space. And they have repealed that particular cabinet decision and ministerial decision on 20th of November 23 and replaced it with a new decision on this particular front, which was quite a good news for this particular industry. And the good news was that they have included one particular bit, which is trading of qualifying commodities as exempt from corporate tax if it is done by free zone entities. And free zone entities are not limited to only designated free zones, for any free zones that for that matter. So which included a lot of entities who are the bullion traders, and if they are in any of the free zone, they came into the ambit of this particular exemption that came in the new ministerial decision. Manufacturing of activity in any free zone was anyway part of the first ministerial decision. So if a jewelry manufacturer in a free zone is already benefiting from this particular exemption that applies. Diamond still remains a challenging matter, and it is subject to different interpretations from different people, but most likely diamond trading, pure play diamond trading, is unfortunately still not covered in any of the explicit decision that came out from the FTA. So now where we stand is almost all the dust related to applicability of taxation on this industry is cleared. Almost all the dust. Lot of clarifications has also been provided by the guide that is published by the FTA. Apart from ministerial decisions and cabinet decisions in the law, one has to read all these in conjunction in order to form an opinion. And I mean, sometimes still when I meet people, they say that clarity related to free zones is not there. And my answer to this question is, it is absolutely there. Of course, things can change in Dubai. Things keeps on changing in Dubai, for that matter, which nobody can control. But whatever been issued by the FTA in terms of laws, ministerial decision, cabinet decision, clarification documents and all, things are very, very clear. And based on that, my colleagues Karishma and Kunjal will walk you through the clarity that is there in our mind, and also to help you answer any of your questions that you may have towards the end of the webinar. So I leave the floor to Karishma to walk you through the slides, which will help you, get better understanding, particularly in details related to this industry. Over to you, Karishma.
Thank you, sir. Thank you so much for setting up the context specifically for today's audience that is into jewelry businesses. So before diving into the tax applicability, I would first like to explain everyone that once you are a business setup, once you want to set up your company, the first question which arises to your mind is, where do I set up my company? Do I set up into a mainland or I set up into a free zone? Now, every free zone or every mainland, wherever you want to set up your company, has its own pros and cons. We have tried to summarize for your better understanding. If you are a new business and you want to set up your business into mainland, what are the considerations or what are the things you should be mindful of? And of course, with respect to the tax applicability, what will be the tax applicability vis-a-vis what will be the tax applicability in free zone? So just to summarize, of course, physical office would be mandatory under both the cases. In free zone, currently it is not mandatory, but if you want to claim the benefit of 0% taxation, that will be later on explained in the presentation, then definitely it becomes mandatory for you to have an office space. Secondly, mainland is regulated by only one authority, that is the Department of Economic Development. While if you go for a free zone, every free zone has its own separate free zone authority, and you have to comply with the rules and regulations under which free zone you are trying to set up your company. The another important and hot topic, yes, it will be with respect to the corporate tax. If you're into mainland, straight away, no exemption. You have to pay 9% of your taxes if your net profits are exceeding 375,000 dirhams. Comparatively, if you set up your business into a free zone, then you have an option, you have some benefits available, and you may be eligible to claim 0% tax on the income that you're earning out of trading or manufacturing or processing of your gold and diamond. That will be explained in detail in the latter part, but yes, you may get this benefit of 0% taxation. When it comes to mainland with respect to visas, as that is one of the important concerns, there is no visa restrictions currently. It will depend on the office size that you will be setting up your office in the mainland. While in free zone, yes, there is some limitations. Then you will have to pay an extra amount for whatever visas you want based on the staff you want to acquire. Then audit, yes, under mainland, it is mandatory to get your books of accounts audited and submitted to the authority, to the DED department. While in free zone, it will depend on case-to-case basis. Do you have to mandatory get your books of accounts audited or not? But now being into the corporate tax regime, it will become mandatory if you want to claim the 0% taxation. So that is an overall objective of setting up the context. Okay, if you want to set up in the mainland, what are the things you have to keep in your mind? And if you want to set up in the free zone, what are the things you will be mindful of? I would not go into the detailed part, as today prima facie our objective is to help you identify, okay, what will be the tax liability on both these considerations. So moving on, as I already told, that if you're into a mainland, straight away there is no benefit and you will be liable to pay 9% of the taxes if your net profits exceed 375,000 dirhams. So on the mainland, you have an option that either you set up your business as a natural person, like it is just a sole proprietorship, where you do not have distinction from a person and a company. It's a one-person company or it's a single shareholder company. When it comes, you would be treated as a natural person. And if you get the status of a natural person under the UACT and you're earning a revenue of say less than or equal to 1 million, then up to 1 million of your income would not be subject to any tax and you are not liable to pay any taxes on the same. However, the moment your revenue exceeds 1 million dirhams, then you would be taxable at standard rates, that is at rate of 9% about 375,000 dirhams. Now, this annual revenue is to be calculated based on your calendar year. So for natural person, unlike the other juridical person, you have an option that you can select which financial year you want to follow. But unlike natural person, for natural person, there is straight away only one financial year, that will be the calendar year. So for Jan 24 to December 2024, you will have to identify, is your revenue exceeding 1 million or is it below 1 million? Based on that, your taxability will be determined and accordingly the taxes would be liable to pay. Irrespective of that, if you're a juridical person, that is a legal person, straight away taxable at 9%. Now coming to the free zones, as I already mentioned, free zones have certain benefits that has been offered and it continues, although not on the similar basis, but yes, there are certain benefits which are continuing. And on the similar lines, if you become a qualifying free zone person, then you would be taxable at special rates. Now, what are these special rates? Special rates is 0% on your qualifying income. What exactly is qualifying income? I'll take up in the latter part of the presentation, and 9% on your non-qualifying income. While if you get a status of a non-qualifying free zone person, then your entire profits would be taxable at standard rates, that is at the rate of 9%. So I hope this explains you about the understanding, okay, what will be the tax liability if set up into a mainland and into a free zone. Now coming specifically to a free zone, as I mentioned that you have to be a qualifying free zone person to claim the benefit of 0% taxation. Now how would you be treated as a qualifying free zone person? So there are 6 conditions which you will have to satisfy, and once you satisfy all these 6 conditions, you will be treated as a qualifying free zone person and your entire income would be taxable at 0%. The very first and important condition for businesses should be that they maintain an adequate substance. Now, what is an adequate substance? I'll take in the latter part. Then you need to derive a qualifying income. You need to not elect for a normal taxation, that is at the rate of 9% on 375,000. Thirdly, the de minimis requirement needs to be satisfied. You maintain your audited financial statements and you comply with transfer pricing rules and regulations. So you need to foresee that all these 6 conditions are completely satisfied to be treated as a qualifying free zone person. Even if one condition is not fulfilled or not maintained, then you cease, you do not retain the status of being a qualifying free zone person, and for that particular year in which you fail to meet any of this condition and subsequent 4 tax periods, you lose the benefit of being a qualifying free zone person and your entire income then comes under the purview of normal taxation, that is at the rate of 9%. Even if you get the status of being a qualifying free zone person, for you, the registration and the written filing would be mandatory. There is a deadlines which are being specified according to the FTA decision. According to your license issuance date, you need to get your corporate tax registration done, and written filing would depend on the financial year that you are following. 9 months within the end of your financial year, you will have to file your corporate tax return. Now let's deep dive into what are these 6 conditions which you will have to fulfill to maintain the status of a qualifying free zone person. Very first, as I mentioned, it's an adequate substance. So for adequate substance, it says that the core income generating activities, that is as in your case, which is a trading of jewelry or a trading of gold and diamond. If you're generating the core income generating activities within the free zone, you have an adequate assets, that is you have a proper office, you have a proper setup, you have proper furniture and everything set up, you have adequate number of employees and proper adequate number of operating expenditure are being incurred from the free zone where you are set up, then it is said to be satisfied that yes, you have an adequate substance maintained in the free zone and you get that benefit, and one tick mark is done. Then comes the second condition, second and the most important condition, that is you derive a qualifying income. Now to simplify what exactly is qualifying income is, suppose you are set up say in DMCC and you are doing your business, suppose with another free zone, that is say DIFC. The moment you are doing business from one free zone to another free zone, any income, any sort of income that you are deriving from the another free zone would be coming under the ambit of qualifying income, and whatever income you are generating from this another free zone would be treated as a qualifying income, thus taxability is 0%. Now, the moment you are dealing outside the free zone, suppose you are set up in DMCC and now you are dealing with the mainland entity or any outside the UAE, now the income that you are deriving from this mainland entities or outside the UAE has to only be a qualifying income from only a qualifying activities. The 13 qualifying activities are being specified, and the moment any of these activities you are conducting from mainland, income earning from a mainland or outside the UAE would be treated as a qualifying income. Apart from that, Suppose your main activity is trading of gold, but you are also having some interest income, or say any other consulting business, sometime that income that you are generating. Now, this is not your main source of income, correct? This will be treated as your non-qualifying income. Now, if the non-qualifying income is less than 5 million or 5% of your total revenue, that is from your main business activity as well as from this other business, if it is less than 5 million or 5% of your total revenue, then it is said to be satisfied that yes, your other income is within the de minimis requirement. And with that respect, the entire income would be treated as a qualifying income and thus taxable at 0%. So that, and apart from that, any income that is derived from ownership and exploitation of an qualifying intellectual property would also be treated as your qualifying income. If you are not earning any of these activities income, then your entire income would be treated as a non-qualifying income, taxable at 9%. Now, as I mentioned that for a qualifying income, you have to earn a qualifying activities income. Under that, for specifically as we are dealing today with the jewelry businesses, so if you are into jewelry business, you are doing the manufacturing or processing of your gold or distribution of your goods. And thirdly, as already mentioned by Sheetal sir, that now the qualifying commodities includes dealing trading of gold and diamonds. Diamonds is still subjective, but yes, if you're particularly dealing into gold, then it also will be treated as your qualifying activities. Hence, this is the benefit that you would derive out of setting up into a free zone. Now, what exactly would be the taxability under all these three scenarios is explained over here. Suppose you are dealing with, you are set up into a free zone, as I already mentioned, and deriving income from another free zones, straightforward qualifying income. If you are into manufacturing and processing of jewelry, suppose you are buying the gold, raw gold, and then you're processing it and making a jewelry and distributing, or subject matter, you are distributing it from your free zone, then also it will be treated as your qualifying activity and thus a qualifying income, taxable at 0%. The important aspect comes when you are dealing into trading. If you are just a pure trader business, you are not doing any manufacturing, you are maybe just importing the jewelry or just exporting it or just importing and selling it locally. The moment that is purely gold and raw or precious metals, then it will be a qualifying income. But the moment it becomes a jewelry and processed metals, like you're purchasing gold jewelry, suppose say from Africa, and then selling it to India, in that cases, it will not be treated as your qualifying income. The reason being, the trading of gold, qualifying commodities very clearly specifies that it has to be into raw form. Now, jewelry does not come into the raw form, and that's the reason when you are dealing into jewelry trading, at that moment, it is not a qualifying income for you. So that these are the major taxability for if you are setting up into a free zone. For mainland, as already explained, straight away would be taxable at 9%, irrespective of whatever business. May it be trading, may it be processing, may it be manufacturing, will be straight away taxable at 9%. Now, for the further part of what are the other relevant provisions you need to keep in mind when dealing would be explained by my colleague Kenjan.
Thank you, Karishma. First of all, I would like to thank Sheetal for laying down such a powerful context and Karishma for deep diving into the most complex subject of UAE corporate tax, which is free zone taxation. What I will be discussing with you all is how you cannot pay taxes or reduce your tax liabilities even if you are not in free zone. So clients, typically small businesses, come to us and say, Kinjal, we are not in free zone. We are newly set up businesses. We don't have much turnover. And we do not wish to pay 9%. Is this possible? Of course, this is possible. And for them, we have a counter question. You said you are small. So what is your turnover? They ask, why is this relevant? Now, this is relevant because there's a specific relief called small business relief in which no taxes are required to be paid when the revenue is less than 3 million. Listening to this, many business owners become happy and they tell us, so my business is never expecting to cross 300 million. So I never have to pay taxes. Now this again is a critical component since this small business relief is only available till 2026. Still, businesses are relieved that till 2026, no taxes, no compliance. But again, there is a catch here. Although no taxes, compliances like registration on the Imara tax portal, a return, although a simplified one, will still need to be filed. And once you are opting for small business relief, you cannot carry forward losses pertaining to that year. Accordingly, corporate tax provides many such reliefs which would make life of a businessman easy. But there are so many tricky points that the businessman will have to make these choices very prudently. Now, again, there are people to whom the small business relief would not be applicable. So, if you are a member of a multinational group and your group turnover is exceeding 3.15 billion, still you don't want to pay taxes in UAE at the rate of 9%, sorry, boss, that is not allowed. Now, as Karishma elaborately explained the free zone concept, some of our clients are in free zone, but since there are so many conditions, they don't want to do audit, they don't want to do TP. So they are like, we have revenue turnover less than 300 million. So can we opt for small business relief and be relieved till 2026? Now here, what QFZPs have to be mindful of is that if you are electing for small business relief, then small business relief is only till 2026. And in case of a free zone, if you opt out of the free zone benefit for next 5 years, you cannot select that free zone benefit again. Again, repeating, businesses have to be mindful of these complex situations which are there and have to do the analysis very carefully before choosing any option. So this ends the story of how you can not pay taxes. Karishma, can I see the next slide? Now, talking about majority of the companies who are not in free zone and their turnover is way more than 3 million, can they still not pay taxes? The answer to this is very simple. If you are profitable, there is no way you cannot pay taxes. What you can do is just optimize, or for a simpler word, save taxes. How? The first step is knowing on what portion are you required to pay taxes. Your starting point is your accounting income, which is your income as per the books maintained. But you are not required to pay taxes on the same. The accounting profit is to be adjusted for various reliefs relating to transitional provisions. There is a period where there was no tax. Exempt income, for instance, domestic dividends, they are exempt, and no taxes are required to be paid on the same. Your unrealized gains, losses, there are provisions which allow you to tax gains on certain assets only when they are realized. Was in the accounting treatment which requires you to book gains or losses even when they are unrealized on accrual basis. You have a lot of deductions which you can take under corporate tax provided you book all your expenses correctly. And of course, there are also provisions for carry forward of losses. Very much overwhelming for you all. We'll discuss it in detail step by step. Kashma, can you see the next slide? The starting point will always be the accounting profits. Here, what is critical for all the businesses is that you'll book all the expenses incurred for the purposes of business correctly. All revenue expense, that is your routine expense, would be allowed in the same year. All the capital expenses would be gradually allowed over a period of time in the form of depreciation. What is relevant for businesses is also to know that which expenses are deductible, which expenses are not deductible, that is straight 9% tax, and which expenses are partially deductible. So here we have three buckets. First bucket is which we already discussed. Revenue expenditure incurred wholly for the purposes of business are fully allowed. No one can disallow any portion of that expenditure unless they are specifically disallowed or they are specifically stated to be partially allowed. Now, what is fully disallowed is any expenditure which is not incurred for your business. Any expenditure which is incurred for your sister company's business, you cannot claim in this business. Any donations which you are paying to entities other than specifying qualifying entities, not allowed. Any grants, gifts, fines, car fines paid. Specifically, there are a lot of questions which come to us that can a car fines be allowed? No, not allowed. Any penalties, bribes, dividends, any dividends distributed or any profits distributions, any drawings taken by a partner or a sole proprietor, or any taxes paid, for that matter, even VAT or corporate tax paid would not be allowed. VAT would be allowed only when it is irrecoverable to get a credit of the same. And talking about the third bucket is which expenditure is partially allowed. Now, there are two special nature of expenses which are specified very clearly in the corporate tax. One is entertainment and another is interest. Now, entertainment expense is crucial for all businesses because it is the day-to-day expense which relates to meals, accommodations, transportations. Now, when this is incurred for clients, partners, suppliers, shareholders, now this bucket is very vast. It covers your clients, it covers your partners, it covers your suppliers, it covers your customers, and it also covers your shareholders. And it has all sorts of expenses which one would incur for recreation or any such purposes, which includes meal, accommodation, transportation. Here, the government authorities are making an assumption that there is some personal element which is there in this expense. And therefore, what they are doing is they are deemedly disallowing 50% of this expenditure. Although you are incurring 100% of this expenditure for your business purposes, still you will have to disallow 50% because here there is a deemed disallowance which has got attracted. Now, here a very important and crucial thing to note while doing the accounting as well as computing the tax liability is that any expenditure incurred for employees or staff benefit is 100% allowed. So, any expenditure incurred for your partners or clients, not allowed, but any expenditure incurs for your employees or staff, here the government has shown a little leniency and said that any expenditure which you include for your employees or staff will be 100% allowed. The second special nature of expenditure is the interest expenditure. Now, here this restriction will only apply when the interest exceeds AED 12 million. So, it is only applicable for businesses where the interest component is exceeding 10 million. And what the law is stating that when the interest component exceeds AED 12 million, then only it has to be restricted to 30% of the operating profits, and the remaining interest can be allowed over a period of 10 years. But for the current year, if your interest expenditure exceeds AED 12 million, it has to be restricted only to 30% of the operating profits. Can I see the next slide, Karishma? Next. Now here, what happens if you are a loss-making entity? Then, of course, you don't have to pay any taxes. And the best part about the UACT law is your your losses can be carried forward indefinitely every year. But there is a restriction that only 75% of the loss will be carried forward. And again, the remaining 25 can be carried forward for a period of years. But for that particular year, when you're carrying it forward, it has to be restricted to 75%. Now, another critical aspect here is that even though loss making, businesses will have to do all the compliances. That is, all the registrations, return filings will still be have to done. And also, there's a thumb rule attached here that any losses for the period where you weren't taxable, any losses for a period where you weren't subject to 9% would not be allowed to be claimed by carry forward or anything. So any losses which you would have incurred to a period prior to June 2023, or if your tax year falls from 1st Jan to December, then prior to 31st December 2023, those losses will not be allowed to be carried forward. Now, one client came to us and he was saying, I have 5-6 entities based out of UAE and I have loss in one entity. Can I set it off against my profits of another entity? Because I'm a part of a group. So it's just, it's a part of my business, my entire business. So can I do this intra-company group set off of losses? And here comes a very interesting concept which can help businesses reduce the compliance, which is the concept of tax grouping. Karishma, can I see the next slide? Tax grouping is a concept which allows entities of a same group to become a single taxable person. Now, you would say this has a lot of benefits because I can do only one filing of return of income. This might reduce my compliances, this might limit my transfer pricing, but it has a con to it also, which is that when you are forming a tax group, you will only get a single exemption limit of AED 3,75,000. As Karishma has mentioned in the start of the presentation itself, that profits exceeding AED 3,75,000 are subject to 9%. So in this case, when you are forming a tax group, you are being treated as a single taxable person, and single taxable person would only have a single exemption limit. Accordingly, any such analysis of forming a tax group, a thorough cost benefit analysis would be required to see whether a tax group can be formed or not. And apart from a very crucial condition here is that all entities should be UAE juridical person. Now, apart from this main conditions, there are also other conditions which can be adjusted to if you are forming a tax group, like your tax years have to be aligned. No entity should be a qualifying free zone person, because if you're a qualifying free zone person, you're not paying any taxes. You are treated as a special person. So no entity should be a qualifying free zone person or exempt person. So all these conditions are required to be met apart from all the entities being a UAE juridical person. Now, repeating again that such analysis have to be done very carefully because it has pros and cons to it. So whenever a decision has to be taken to form a tax group, a thorough cost benefit analysis would be required. Karishma, can I see the next slide? Now, I'm very sure a lot of people must have heard about it and must already be very much upset because of this new concept which has come, which sounds and is more heavier than the UAE corporate tax law, which is the transfer pricing. So, right now, I'll very briefly touch upon transfer pricing concepts, which would be relevant for traders, manufacturers, assuming that you would have related party transactions and to comply with the transfer pricing, all your sales and purchases. Given that the industry we are looking at, I'm sure that there must be a lot of sales and purchases which would have been made from related parties, and all these transactions would have to meet the arm's length principle. Now, when I say arm's length principle, which means that the prices which are paid for purchases and sales would have to be made in a similar way as it would have been made in case of a third party. You have to disregard the relationship which you have with your related party and deal with that related party as if you would have dealt with an independent third party. That is, you cannot have any favorable pricing or conditions for your related party. Here, there is a very common misconception that only international transactions are subject to transfer pricing. Yes, this is the case. This is the case for most of the international jurisdictions, that only international transactions are subject to transfer pricing. But UAE being a unique destination itself, it also, for UAE entities, even local transactions which are entered with another UAE entities are also subject to transfer pricing. Just to give you an example, a UAE entity dealing with companies from India and Africa have to definitely comply for transfer pricing. But a UAE entity dealing with another UAE entity where it can establish a relation, even those transactions have to be complied to with transfer pricing and accordingly the arm's length pricing. Further, there's no specific threshold beyond which the transfer pricing would apply. Accordingly, even 100 dirham sale has taken place to a related party, transfer pricing would apply. Now, here there is another keyword which you must have heard in a lot of the cases, which is benchmarking of transactions. Just one second. Which you must have heard is the benchmarking of transaction. Karishma, can I see? No, I need this slide only. Yeah. So benchmarking is another buzzword which you must have heard. In benchmarking, what happens is the transactions which are taken with the related parties are tested to see if they are undertaken at the same value, the same conditions, and the same margins as they would have been transacted with an unrelated party. So benchmarking is a test, and once you go through this test, a report has been issued which has to be kept in your documentation to substantiate going forward to the federal tax authorities that yes, my transactions which I have taken with the related party are at arm's length price. Now, given there are various methods which are prescribed for benchmarking, we'll not go into detail of this method, and if required, we can conduct another webinar specifically to transfer pricing where we explain each of the methods in details. But for the benefit of the community at large, two methods which are largely used is when you compare a price with an unrelated party to benchmark the price of your transaction. Now, given the specific nature of gold industry and specifically talking about jewelry, the prices keep fluctuating. And it might be challenging to every time benchmark the sales and purchases. And therefore, there is another method of benchmarking which is commonly used, where profit margins are benchmarked as per industry standards. And once profit margins are benchmarked, then you don't need to benchmark sales and purchases transactions separately. So even that can be kept in mind and discussed as and when required, that would it be prudent to just benchmark profits in case of a specific industry like gold where prices keep fluctuating. Now, transfer pricing, as it is evolving, it would require maintaining a lot of documentations to substantiate what is to be done, how it is to be done, and what is more and most important is what is the basis of doing something. Accordingly, it is a one time exercise which will need to be undertaken and will involve businesses working along with the practitioners to set the policies and documentation. Also, given that gold is a volume based industry, additional compliances will trigger in terms of documentation, which we'll discuss later. So, with this, we jump on to the most relevant part of this webinar, which is in the terms of compliances. So, Karishma, now since we have educated everyone regarding what the general corporate tax laws are, would you like to educate the audience more regarding where they should start from and what would be most critical aspect for them?
Sure, Kinjal. So coming to the very important part now, as you have set up your business, everything is up and running. Now you have started your business. First and most important things that you need to be mindful of and start working on is maintaining your books of accounts. Earlier, books of accounts were not that mandatory or there was no submission as such, but now coming with the corporate tax, yes, it's become a very important aspect. You need to maintain your proper books of account as per the IFRS. Now you can choose the basis to maintain your books of accounts. Suppose if your revenue is say more than 3 million dirhams as explained by Kinjal when it comes particularly with respect to small business relief, then if it is more than 3 million dirham, then mandatory you need to form it on an accrual basis. However, if it is less than 3 million, then you may opt for maintaining your books of accounts on cash basis rather than an accrual basis. And if you are a small business with revenue of less than 50 million, you may have IFRS for SMEs. And where your revenue exceeds 50 million, it will be mandatory to follow the IFRS. But this becomes an important and first and foremost step to maintain your books of accounts. Once your books of accounts are maintained, the another important aspect comes with respect to the corporate tax registration. The corporate tax registration due dates are now very clearly specified via an FTA decision in which they have very clearly specified if you are an existing company like which was set up before 1st March 2024, then for all those companies the registration deadline would depend on the trade license issuance date of the company. However, if you are a new company, that is any company which is set up after 1st March 2024, that is the date on which this decision ruled out, all those companies need to register within 3 months from date of their incorporation. That means if you are set up say on 14th of March 2024, then due date for you becomes from the date of incorporation you have to count. So it becomes March, April, June, that's 13th June 2024. If you do not register within the same deadline, then there are penalties which will be further explained by Kinjal. But yes, these are the first two initial steps. Now comes to the audit part. Now I was already explained that if you are into mainland, for you it becomes very much mandatory to get your books of accounts audited if your revenue is exceeding 50 million dirhams. But the moment you are into a free zone person and you want to opt for the benefit of a qualifying free zone person based on all the conditions and you want to fulfill and claim 0% tax benefit, then also it becomes mandatory for you to get your books of accounts audited. So these are the first initial 3 steps that you should be mindful of before getting into the written filing and other aspect. So Kinjal, would you like to take for what are the further steps or what are the further compliances anyone should be mindful of?
Sure, Karishma. Thank you for highlighting for the audience the most 3 critical step where they need to start and what has been different from a pre-tax period where things were not maintained versus now where a proper audit would require. Now, as everyone knows, return filing will be an obligation which will have to be done 9 months from the end of the close of the financial year. And return filing will be an obligation for all person, whether they are claiming for any reliefs, be it small business relief, QFZP, whether you have losses, everyone has to file a return of income. Now, along with the return of income, the form which gets oversighted is the TP disclosure form. The transfer pricing guide specifically mentions that there is a TP disclosure form which has to be filed along with the return of income. And while the form is yet to be released and mandatory thresholds yet are to be prescribed, businesses will have to be mindful of this filing. Two another critical documents which are to be maintained from a transfer pricing perspective are local file and master file. Now, these are to be maintained if the turnover exceeds 200 million or if you are a part of an M&E group. These are a part of TP documentations and will have all the details relating to the related party transactions, group structure, policy follows, etc. Now, given that the business we are looking at, where we are looking at big volumes, these 200 million limits gets easily crossed sometimes for gold businesses, and therefore it is essential that local file and master file is maintained. There is an exemption of maintaining a master file if a group is operating only based out of UAE. Then there is an exception that even if you cross the 200 million dirham turnover, still you don't have to maintain master file. But again, even if things are not mandated from a transfer pricing perspective, it is advisable that since we are entering first time into a tax period, we do keep essential documents which would enable the FTA to easily determine the pricing so that it does not arise into any litigations further. Can we see the next slide and come on to the most painful point for all the businesses, which is the penalties? We are in UAE, so every non-compliance has big fines. And the line which we often use within our clients is that in UAE, the cost of compliance is less than the cost of non-compliance. So for all compliances we mentioned, there are penalties which are prescribed in the law. Starting with late registration, the penalty is of 10,000 dirhams. Late return filing fee has a recurring penalty, which is 500 for each month for first 12 months, and thereafter 1,000. So this is not even a flat penalty. Your penalty will go on unless you comply with what is required to be done. Then if you don't pay or you fail to settle the tax liability, then the penalty is the charge which would get attracted to it is 14% per annum. And again, if you fail to maintain records and other documentation, the charge is 10,000 dirhams. So yes, there are penalties, and we have seen penalties being levied, being issued for late registration. No relief has been provided, even if there is a delay of 1 day. So the intention is to take the law and related compliance seriously and strictly. And therefore, it is recommended that businesses are made aware of the provisions and its complexities. And this is the time to act if not acted yet. So with this, it marks the end of our session. And we would like to open the stage for you all to have any questions for us.
Yeah, thank you, Kinjal, for a very insightful slides that you presented towards the end of it, which is the compliance. Knowing when to file the return, when to register. I think these are the first few basic questions that we should all be mindful of. Because failing to register, attracts penalty, and they're not have been very easy, handed on that front. Determining whether you are taxable or not taxable, you'll have probably some time to figure that out. So
Right.
there are few queries, related to tax group,
Right.
and also related to gold refining. Let me read the query that Hina has raised. If a holding subsidiary relationship is established within the year, are they eligible to form a tax group during that period? Question mark. The procedure began in 2023, but the updated MOA was only received in March 2024. So any views on this, Karishma or Kinjal?
Sure. So, Hina, I would like to just elaborate on your point that for tax group, if you want to form any of your entity as a part of a tax group, the first and foremost condition is that you have to maintain all the conditions for entire 12 months period. If it is an existing company that you have already set up the company, say 4 years or 5 years back, and now you want to form a tax group, then it has to be satisfied for entire 12 months. However, if you're forming a new entity, it's a new company which is set up, say, suppose in 2024, that is the beginning of your first corporate tax period, I'm assuming, if you're following Jan to December 2024. Then, if the new entity is set up and you want to make that entity part of a tax group, then yes, it can be formed a part of a tax group. So, we'll have to see the exact facts of your company because you have just mentioned that is established in this year. So if it's a new company, then yes, it can be formed. But if it is an existing company and although you are not able to comply for entire 12 months this condition, then it will not form the part of your tax group. So I hope this clarifies. You can give us the details and we will be happy to more elaborate on your this query.
From the question, it appears that it is a new one. So
Yeah.
yes,
So
that is the
just
case, then
one point I would like to add. You can form a tax group if it is 95% holding and above, correct? But there are other provisions. There is one more provision which can allow you to transfer the losses if one of the entities making losses between the qualifying group. So say even if you might not be able to form a tax group for that particular period, if the holdings is more than 75% of the above, you can still avail a benefit of transfer of losses. If there is a situation where in one entity there is a loss, in another entity there is a profit.
right.
I think there are few more queries. I mean, this is one interesting one. This is gold refining a qualifying activity. If yes, under which qualifying activity? You want to share anything on this, Karishma or Kinjal?
So gold refining, I don't know who has asked this question. So whosoever has asked it, gold refining may come under the definition of processing of goods or materials. So there are certain conditions, of course, that you will have to fulfill. We can see if gold refining would come under all these definitions, as refining would usually mean mine oring or when you're doing any kind of raw material, raw form. So if gold refining would come, it may come under the definition of a processing of goods or materials, and under that activity, it can be treated as your qualifying activity, and thus income out of it qualifying income.
Yeah, in fact, our view is that a gold refinery, if it is in any free zone, be it DMC or any other free zone, will be subject to the qualifying activity list that we have for processing and manufacturing of goods. So this will be one of the qualifying activity. And there is so qualifying.
There's one question which says election of tax group is non-revocable or can it be revisited every tax period. Although it can be revisited, it should not be revisited because there are a lot of complexities when you form a tax group and when you want to come out of the tax group. Because all your balances, as we said, your carry forward losses, your interest, if there is any disallowance, excess 30%, all those balances will have to be re-looked at if your particular entity is exiting a tax group, and therefore it is not a revocable. It is a revocable option, but yet to form a tax group, a decision to form a tax group itself will have to be taken in a mindful manner, since changing the mind then would have additional compliances and additional balances to be maintained. Trading activity deal with mainland customer.
More a trading activity or service activity and deal with mainland customer. Also lose their 0% tax benefits on all income. This is an interesting question. Is the qualifying free zone entity who are in trading activity or service activity and deal with mainland customers also lose their 0% tax benefit on all income, right? See, Raji, this question unfortunately cannot be answered in a simple manner. I'll tell you why. Because any service activity, unfortunately, is not part of any of the qualifying activity list, correct? In any of the free zone. So any services that you are doing in any of the free zones is subject to normal corporate tax rates. However, if you are in the trading of goods and that too you are doing from qualifying free zone, that will be subject to exemption, right? Irrespective whether the customer is in mainland or if the customer is in free zone or if the customer is overseas. However, if you are a trader, say for example a jewelry trader based out of non-designated free zone, then you will be subject to corporate tax if it is sold to mainland, or for that matter, if it is export even. Yeah, only free zone to free zone, if you are doing trading, then to that extent you will get the benefit. So it's a complex question, I think number of questions within one question, but hope this answers this. Anything that you want to add, Karishma, Kinjal, Pratik, please feel free to. I think there is one more query. Goods sold by DMCC to GDP, Gold and Diamond Park free zone. Retail outlet will be considered as qualifying activity. See, one thing, as a part of list of exception, right? Which is that anything that you deal with any retailer, correct? Will even if you are a retail shop and you are selling to individual customers, be it ice creams or be it jewelry, right? That is subject to corporate tax. You don't get the free zone tax benefit, right? So a retail shop selling to individuals will not be able to, even if it is in free zone, will not be able to do that, have that benefit. However, a trading entity from a free zone to selling to another free zone entity, right, can avail this benefit, which is probably the question is, provided all of it relates to that, all the business relates to this particular bit of trading. If more than 5% of the trading happens, say for example export or to mainland, then you lose the benefit of whole of 94% that you have, which is free zone to free zone. So if it is a pure play 100% business is free zone to free zone trading, it will be subject to corporate tax. It will be subject to exemption from corporate tax. Hope this clarifies as well. I think we are getting a lot of questions. Let's take the questions with name first rather than anonymous ones. Yeah, so this question is from Shiva. He's asking, does physical gold trading on a regulated exchange, DGCX, qualify as a tax exempt activity? Please elaborate. Let me clarify. The physical trading of gold, if done by any free zone entity, is subject to corporate tax exemption. Because the way they have clarified it is that whether it is done on an exchange or out of exchange, or if it is pure play trade where you are buying from somebody and selling to somebody else, it is subject to exemption from corporate tax. I mean, further to elaborate on this, this is not only on gold, but it is on wider set of commodities, be it other metal commodities like iron, be it copper, metal commodities in general, other commodities like oil and gas related commodities, or for that matter agro commodities, as long as they have defined the commodities as that is traded on a recognized exchange in a raw form. So any commodity which is traded on a recognized stock exchange in a raw form, all those physical trading of such commodities, if done by a free zone entity, is subject to corporate tax. I think one of the most burning question in case of gold, diamond, and jewelry industry is about diamonds, because as the definition says that that trading of qualifying commodities, and qualifying commodities is defined in a way which is traded in a raw form in a recognized stock exchange. Unfortunately, diamond is not traded in a raw form in a recognized stock exchange in our view. Somebody may say that there is Rappaport guide, and diamond is traded out there as well. So which is which it in our view a bit of a stretch of imagination. So apart from jewelry and diamond, I think pure play gold trading falls under this particular definition and can get the benefit of exemption. So hope this clarifies as well. My company starts in May 2023, so I'm eligible for filing tax return because my company earning more than 3 million. First, since your company starts in May 2023, I think you need to be mindful of when is your first return. So maybe Karishma or Kinjal, last webinar we have done on this particular topic. Can you shed a light on when, for companies which are formed recently in 2023, how their return filings are, and some of their return filings are even falling due in September. Maybe this year, this September, which we are in.
Yeah, sure. So the thumb rule here is your date of your financial statements is your first tax period. So in this case, your financial statements will be prepared for I think 8 months starting from May 2023 to December 2023. In case you are following Jan to December, we also need to know which year you are following, which tax year you are following. I'm assuming you would be following Jan to December. So your first financials would be prepared for May 2023 to December 2023, and your first tax period would start rightly from 1st January 2024 to December 2024, and therefore your first tax return would be due on 30th September 2025. Hopefully you have done the registration, so no penalties will attract, and your first return filing will be due on 30th September 2025.
But the question was whether they will be able to claim 3 million relief, small business relief, which yes, you will be able to claim. If your turnover is less than 3 million, then you would be able to claim a small business relief.
Yeah. They'll be able to.
However, it will be eligible for the next year, that is Jan to December 2024. The revenue which is for the past year, that is since your business was set up till December 2023, that would not be considered. The first tax period, which is Jan to December, you'll have to consider 3 million benefit for that one.
And suppose if their entity would have been formed in June 2023, then what would have been the
June 2023, then yes, for the companies which are particularly set up in June 2023, for those entities, the return filing would be due by 30th September 2024. The reason being, your first tax period would be your first financials that you will be preparing, that will be from the date of incorporation. You have an option that once a new entity is set up, you can have 6 months to 12 months, 18 months as your first financial year. Unfortunately, for the companies which are set up in June 2023, what will happen is you have to prepare your first financial year considering June 2023, since you were set up till December 2023. That will be the first financial year you will be considering. And accordingly, your whatever profits you are generating during that period would be liable to tax. And your return filing is due was now on 30th September, that is just 20 days away. So any companies, if you are set up in June 2023, be mindful that your return filing is just 20 days away. You'll have to recheck. If you already have certificates, unfortunately, the thing is, the earlier setup companies, which were already registered for corporate tax, if you have a certificate, in that it is mentioned as 30th September 2025. But a public clarification came later. In that, it was very clearly specified that you will have to pay taxes for that period as well. So you'll have to revisit your portal and then check again and need to file the return within this due date.
And again, to elaborate, if you are formed in July 2023, then you can opt for a extended period, which is from July 2023 to December 2024. And in case you want to check your small business relief, it will also be for that period. There's no pro rata which is allowed. So your 3 million will range from July 2023 to December 2024. And again, your return filing will obviously be due on 30th September 2025, but we'll have to be mindful of the choices which we will make, which will be before the return filing of income.
So particularly if you have formed during the period of say March, April, May, June, July 23 period, please go and check carefully your incorporation documents and the dates. I mean, and get to the point where, because some entities, particularly those entities who are incorporated during the course of June 2023, their return filings are due this month, right? So please go and check them carefully.
I think there's one more question which is relating to this. The company which was set up in 9th July 2023, but the certificate says the first tax period is 1st January 2024 to 30th December 2024 based on the MONA. Still, we have to file return and pay tax for 2023. In this case, you will have to check for what period are you making your financials. That is the first thing. Because ideally your financials cannot be for a period of 5 months. And the answer to this would not be so straightforward, Raji. You will have to check based on what dates you are preparing your financials. And in case your financials are for a 18-month period. So as Karishma mentioned, right, there is inconsistency between the registration certificates which are issued and the top tax law, which is recently there is an amendment or a circular which has come out. So this would not be that straightforward to answer. 2-3 things will have to be checked in this case.
Yeah, but I think from a pure play law perspective, and FTA is correcting their mistakes, right? We
Yeah.
have seen FTA correcting their mistakes when it comes to portal. From a pure play law perspective, your first tax period you can choose from 9 July 2023 till 31st December 2024 and file the return on September 2025. So from a pure play law perspective, I'm sure FTA would, are changing their, tax periods related to entities like this.
Yeah.
How to deal if option to file return is not yet open and due date is 30th September 2024? So, I mean, it's a very difficult question to answer how to deal.
We are also dealing a solution for the same things because few of our clients are due on 30th September. However, the certificate still says as 2025. So we are trying to figure the way out of it. The only option that currently we feel is we write a specific email to the FTA considering the facts, and then maybe they will open and change details on our portal. Accordingly, then you can deal with it.
I think there is one interesting question from Dinesh Lauti. He's asking if a company is offering tax on realized gain basis, what would be the cost of acquisition of shares, actual cost or fair value at the beginning of the financial year? When it comes to, thankfully there is a special cabinet decision also related to this particular bit when it comes to transition provisions, right? When you are entering in a first tax period from a no tax period, right? So when you are entering on say 1st Jan 2024 from 31st December 2023 when there was no tax, you are not supposed to do any accounting engineering or change any of your audited statements when it comes to transition of books is concerned, right? So wherever you are closing, if suppose you are maintaining your books of accounts on a cost basis, you carry it forward based on cost. If you are fair valuing your assets, then you fair value on 31st December 2023 and move on fair value as an opening balance on 1st Jan 2024. There is a special provision which talks about when things are being carried forward on a cost basis. There, the tax law has given, acknowledged such situations and given a provisions to relief, to give a relief so that you don't pay taxes on a periods, of gains pertaining to periods which are non-tax periods. For example, till end of 2023. You can identify such assets and claim the benefit, related to these assets on fair value basis rather than carrying on a cost basis. So that you can take the benefit of that particular, ministerial decision in this regard. Hope this answers this particular point. Yeah, it's a question not related to diamond and jewelry industry. It's a question related to logistic services. So for a free zone entity, say DMCC, involved in logistics, which qualifies as one of the qualifying activity, true. If the company is handling shipments directly between foreign countries without goods entering in UAE, will this be considered a qualifying activity? Yes, it will be considered as a qualifying activity. There is no such condition that goods needs to enter to UAE or the services, logistic services needs to offered within UAE. So as long as logistic services being offered by a free zone entity anywhere globally, it is subject to tax benefit.
Just to add one thing, what
Yeah.
is important is that the core income generating activities are taken out of the free zone, and you'll have to make sure that your logistics services, which are the business of logistics, is taken out of the free zone, and essential documents to prove that are maintained in your free zone office. And then you can, as Sheetal rightly said, you can deal anywhere around.
Yeah, see this, whenever we forget to say there are number of other conditions apply, you have to assume that, because of course there are number of other list of conditions, substance, it should not be a paper company, it should be a, all the activities related to this has to be, conducted by the free zone, within the free zone itself. So those things, are fundamental to the exemptions that you are claiming, when it comes to free zone tax benefit in UAE is concerned. So I think with that, we have answered almost all the questions, irrespective of whether we have been able to answer. If you still have any further queries, feel free to write to us. We are available at any point of time. And our office is also in DMCC. If you are a DMCC entity, it's a pleasure to invite you to our offices as well. And with that, I would like to extend our, thanks and gratitude to the Golden Jewelry Association, Dubai Golden Jewelry Association, for giving us this opportunity to do this webinar, particularly, focusing on this industry and the aspects related to this industry. And thanks to my colleagues, Karishma, Kinjal, and Prateek for always being upfront in sharing the knowledge and be the agent of change that this region is seeing, and to educate, all the people, our audience, and thank you all for patiently listening and asking all the relevant questions as well. So keep the dialogue on. Force us to think, with your challenging queries, and that really helps us further refine our knowledge as well. Thank you very much yet again.
Thank you, everyone. Bye. Have a nice day.
Thanks for joining.